When I was first buying rental properties, one of the biggest things that held me back was feeling confident enough to know if I was looking at a good deal or one that would lose me money and cause me years of headaches. And fast forward today, we now own properties all across the country in states like California, Florida, Georgia, and Texas, which has given us enough passive income to quit our full-time jobs, to travel the world, and do cool things like learn Japanese in Japan. But this wouldn't have happened if we didn't buy good deals. So in today's video, I'm going to be showing you guys the formulas and spreadsheets that we use to figure out if a property is a good deal or not. Now, by going through this process yourself, you'll save tons of time while minimizing your chances of losing money and maximizing your returns.
Yes! Come on!
To make it easy, I'll show you exactly what I do step by step so that by the end of this video, you'll know exactly what you need to do the next time you get a deal. So I was browsing around Zillow and I found some properties that we can take a look at. Now again, I didn't do any research on these markets or these properties, but I did look for specific properties in markets that I think have good growth potential and to just use as an example basis. So don't judge me, these deals don't come out too well. So the first one we have is here in Brownsville, Texas. And as you can see, this is like a really nice looking home. But the inside of this home looks very clean. Just your typical 3-bedroom, 2-bathroom, 1,200 square foot home. Yeah, this stuff definitely looks computer generated. Look at this. This is not even a real bar. So very interesting how they can use like 3D staging here to make the pictures look better. But yeah, this is a standard home, nothing too fancy in a pretty, regular area. So what we do is we're gonna take this information from the listing and we're gonna go to a property analysis calculator. So I am going to redo all of these numbers for this new property and we'll just keep it side by side. So what we're gonna do is just fill out the sheet. So the purchase price is $156,900. Let's assume that there needs no improvements. And let's assume we're also putting in 20% for the down payment. To find the basic interest rates, I just look at Wells Fargo for now. They have a pretty nice website where it kind of just shows where the interest rates are nowadays. So I like to start using the rates based on this Wells Fargo website, but these rates may or may not be the same for your case. For example, if you have a different credit score, then the rates would be higher or lower. And the rates may also change depending on where the property is located. But it's just a good reference to use for now. And it seems like a 30-year normal conforming loan goes for around 6.5%. For investment properties, this number is also going to be a little bit higher too. So let's keep that in mind. But for now, let's just put 6.5%. We're gonna get a 30-year mortgage. Total rent per month, what we do is we go on Zillow again. So let's get out. So this is where the property's at. So you can zoom in. This is like the area. And what we do is you go and say for sale, change it to for rent. And there doesn't seem to be a lot of homes in the area for rent, but you wanna make sure that you're looking for the same type of home. So you wanna look for homes that are 3-bedroom, 2-bath, around 1,200 square feet. And it looks like you have one good one right here. And it looks like it's renting for around $1,500 a month, which is not bad. It seems like the property that we're looking at is here and it's right next to this giant airport. So it may change the price a little bit in case, people don't want to live next to an airport. But for the sake of this video, we'll just use this comp here, 1,500, as a good example. If the home that we have is 1,200 square feet, it's at 1,040. So let's just say that the cost of living next to an airport outweighs the cost of, the smaller square footage. So here, in this case, we're gonna put 1,500. Let's assume there's no other revenue per month, but in this case, usually you put stuff if you're charging for like a laundry machine or you're charging extra pet fees. That's where this number would go here. Let's do 0 for now. Vacancy rates, typically gonna be between 10 and 5%. This is when your tenant moves out and it takes a few weeks to clean it up before you bring a new tenant inside. Let's put 5% for now. Assume that every single year, you're able to charge a little bit more because of inflation. And we put 3% as your revenue increase. And every single year, things get more expensive as well. So in this case, we're gonna put 2% as your annual operating expense increase. Appreciation, again, this number tends to increase around 3% every single year. In some markets, it appreciates much more than that. But to be conservative, we can put 3% so that it goes up with inflation. In Texas, property taxes are quite a bit. If you go back to our Zillow listing here, they usually have how much things cost. So if you look here, property taxes. Now they write 1.52% for your property taxes here, but I assume that there are some missing things here. Like some places they separate the property taxes with the school fees, but they end up being about the same. In Texas, you're typically paying between 2 and 3% of the property's value in property taxes every year. So in this case, let's just put 2.5% as your property taxes. Now for me, I hate managing my own properties, so I'm very happy to hand that off to someone else. And in Texas, you can probably find property managers in the 8% range. So they're gonna charge you 8% of your gross rents every single month to manage your properties for you. So maintenance reserves are kind of like a phantom cost. What we like to do is reserve 10% of our monthly rents and keep it in the bank somewhere. So this is money that we cannot touch in case a heater goes out or a new roof needs to be repaired. If you have no reserves when these major things happen, then you're gonna be in a world of pain. So even though you don't have to pay these expenses every month, we like to keep them and take it out of our cash flow number so we know if the property is still profitable even after we take away this maintenance expense. In our case, let's just put 10% for now. Now the yearly insurance that you're gonna have to pay really depends on the property's location, the property's condition, etc., etc. If you're really lazy, you can go back to Zillow and use this number here. Although just by looking at this already does not seem correct. Like, I have a hard time believing you can get that property insured in Texas for just $659 a year. It does seem unrealistic. So what I like to do is I like to go to Steadily. They are a nationwide insurance broker where you can type in the property's address, type in some information about them and yourself, and they'll spit out a quote for you. You can then use that quote and put it in here in your property analysis calculator. In my experience, insurance for a property like this is going to be around $1,000 a year. So just put $1,000 here for now. Now the advertising cost is if you are trying to find tenants yourself and you're paying to post your listing or to boost it on Facebook Marketplace or to hand out flyers, etc. In most cases, your property manager will be paying you this cost. Now, sometimes your property manager may ask for half of the first month to compensate for the advertising expenses. But again, all this kind of depends and is a negotiating thing between you and your property manager. In our case here, let's put 0. The monthly utilities for most people who own rental properties, like residential rental properties, the tenants pay for all the utilities and the landlord pays nothing. But if you're owning a multifamily property, then sometimes you may have to pay the water bill. So in this case, we're also gonna pay 0. And HOA dues depend on if this property is in an HOA. I don't think it is. Most single family homes are not in an HOA, or they may have very small HOA dues. In this case, we have 0 here. Now, miscellaneous yearly is if you have any miscellaneous costs that weren't accounted for that you want to just put in the calculator, you can add that here too. Year built and number of units are more just for fun. They don't actually affect any of the numbers here. But in this case, this one was built in 1984, which is not bad. It's a relatively new property and number of units is 1. So now we can scroll down and we kind of see how everything breaks down. If you're buying the home for $156,900 and you're putting 20% down, then you need $31,000 as your down payment. We assume closing costs are going to be around 1% of the purchase price. That's why you're putting in an additional $3,138. So the total cost of the property, including closing costs, are going to be around $160,000, and the cash that you had to put in is $34,000. Now, if you were buying a fixer property and you need to put an additional $30,000, then that would show up here in this improvements tab. And so the numbers and the calculations would change. But in this case, we're just buying a property flat with no improvements. So here you can see how the mortgage breaks down. You're putting 20% down, you're financing $125,000 with an interest rate of 6.5%. Your mortgage payment is going to be just under $800 a month. And you can see the assumptions here as well, where you have one unit, $1,500 a month. Your gross revenue per month is $1,500, so your gross revenue per year is $18,000, and you have a vacancy rate of 5%. So if you scroll down, you can see how everything breaks down in terms of your revenue, expenses, and NOI. Your rental income is $1,500 with a 5% vacancy rate. You subtract $75, even though you're not really losing $75. It's just money you're not going to get. So your net for the year is going to be around $1,425. So this is when you deduct your property taxes, which is around $326 a month, your insurance, which is around $83 a month, your property management fees of 8% is $120 a month, and reserving $150 a month for maintenance and repairs. Now again, this number isn't actually subtracted from your bank account, but over the long run, it is going to be subtracted from your bank account. So it's best to keep these reserves. So your total expenses for the month are going to be around $680 and your NOI is $744. Now, after you take $744, you then subtract your mortgage of $793. And you can see that unfortunately with this particular deal, you may end up being cash flow negative by around $50 every single month. This part down here is a really interesting thing that I developed, which is where you can kind of see where a property kind of breaks even in terms of cash flow. Because as you know, the more debt you get in a cash flow negative situation, the more cash flow negative it's going to be because you're going to have a higher mortgage. But if you had a property where you had no mortgage, then you're going to be cash flow positive. But where's that break even point? So you can see here, you basically have a cash flow break even point at 25%. So if you could put 25% down, then your property would cash flow positive from day one. So again, this is a kind of cool thing you can kind of play around with depending on the numbers. But in this case, if you only put 10% down, then you'd have negative 11% cash flow. And that's something that you don't want. Now, over here is a huge block of text. I'll say don't worry too much about this, but this goes into the nitty gritty of how everything works. Like over time, your gross income is going to increase. Your costs are also going to increase by 2% a year. Your NOI is also going to increase. This kind of shows how much you're paying in terms of your debt service. Like this is your mortgage payments every year. And you can see it's going to be fixed for 30 years straight. Your remaining balance is going to go down exponentially as you're paying off the mortgage. The equity you're accruing is how much you're making by paying your mortgage. And naturally, your property's value is going to increase over time too, and you can calculate the appreciation. So in this way, you can calculate the total return. Because when you own rental properties, you're not just making money from the cash flow, but also from the debt pay down, as well as the property appreciating in value. So even though your cash flow may be negative, your total ROI is actually gonna be pretty high. So yeah, you can see over time how the cash flow increases, how your total ROI increases too. So yeah, as you can see, everything tends to trend upwards quite a bit. So in this case, would I buy this deal? Probably not as it is. I don't like buying properties that are cash flow negative like this from the get-go. Now, of course, if we just took away the maintenance reserves, then it'd be cash flow positive. But since not having maintenance reserves is not realistic, keep it at 10% just to be more safe. So what would I do to make this deal more profitable? Well, I know that I can't really change this interest rate and I can't change this rent. That's just the market. But what I can do is I can potentially put down more for down payment. So let's say instead of 20%, I'll put 30% down. And instead of buying at 156,000, hopefully I can find a deal that's off market and maybe buy something a little bit cheaper. So I can find a deal for 120,000. You can see the deal's a lot better now. You're making a little under 3,500 in net positive cash flow, and your cash on cash ROI is 9%. This key value section is something that I put just so that you can see something right from the get-go, and so you don't have to go through and look at all the individual details and numbers. You can just look at these key numbers and see if it's a good deal or not. Now, as you can see, if I didn't have a calculator like this, then I might have bought a property that would actually lose me money every single month. Creating a calculator like this does take a lot of time and definitely is worth it. But if you guys don't have the time, or if you don't feel confident enough in making your own, you can grab my calculator with the link down in the description. And as a big thank you for watching this video all the way to the end, you can have it for 50% off. Now, finding a deal and making sure that it's good is one part of the equation, but another big part is knowing if your property is in a good location in the first place. Because after all, real estate is all about location, location, location. So if you guys are new to real estate investing and you're not quite sure where to start investing, then check out this video where I teach you guys how to find the best cities to invest in. Thanks for watching. I appreciate you, and I'll see you next time. Take care.